Hello and good morning. Welcome to our VAT webinar today. So today we're going to be taking you through some tips and tricks in terms of VAT, but also some of the complexities that we often see our clients come across and our internal team come across. So you've got myself today. So I'm Shelley. I'm one of the associate directors here at Knights Lowe. So I look after a portfolio of owner-managed businesses, typically in a range of industries. So a lot of these VAT issues come up quite often on my portfolio. I've also got with me today Andrew and Ashley. So I'll just let them each introduce themselves, and they're actually going to take you through the bulk of the presentation today. So Andrew, perhaps if you want to start.
Good morning, everybody. So my name's Andrew. I'm one of the client managers here at Knights Lowe, and I've been at Knights Lowe for just under 3 years now. Previously worked in practice for 11 years, and I've been qualified, excuse me, for 6 years, actually.
Hi everyone, I'm Ashley. I'm also a client manager at Knights Lowe. I've been with the firm for about 5 years now, qualified for about three. I predominantly work with small owner-managed businesses looking after their accounts, VAT and bookkeeping.
That's great. Thank you very much, guys. So like I said, we're going to go through quite a few VAT complexities today. The webinar is going to be recorded. So if you do want to catch up on it at all, it's going to go on our website in the next couple of days. If you have any questions as you go along, there's the question and answer box just at the bottom of your screen. We're intending to get to the questions at the end of the webinar, depending how we are on time. If we can't come back to you during the webinar, we'll reach out to you separately. Our details and everything will be on the last slide. But yeah, as I said, I'm going to hand over to these guys and they're going to take you through the content.
Thanks very much, Shelley. So today we're going to talk about a few different areas of VAT. So to start you off, I'm going to talk to you a little bit about who actually needs to pay VAT, who needs to be registered for VAT, and a little bit about the threshold that is currently set in the UK. I'm then also going to move on and talk to you a little bit about penalties that HMRC can impose, of which there are a few. But it's worthwhile you guys knowing exactly what can happen if, for whatever reason, you're not able to get a VAT return in on time or make a payment. After that, we'll have a look at, I'll pass you across to Ashley, who's going to talk to you a little bit about how the VAT return is completed, how it's calculated, as well as going into how to report any errors that may occur when you're actually completing your VAT returns, because there's different ways of reporting those to HMRC. I'll then talk to you a little bit about VAT reconciliations, the kind of things you need to be looking out for, the best practices to sort of impose when you're trying to complete your VAT returns. Before then moving on and talking a little bit about group returns and the treatment regarding group VAT. It's quite a technical area, so I will touch on it on a fairly basic level, but it's an area that can be beneficial for a lot of businesses, a lot of individuals who have multiple businesses that they own. I'll then move you back across to Ashley, who will talk to you a little bit about bookkeeping side of things. Again, a little bit on making tax digital, the processes. She'll also go into a little bit more detail about the rates and the different rates and what they mean, before ending with some of the VAT pitfalls, the common pitfalls that tend to trip a lot of people up. So without further ado, let's get into it. Okay, so who actually needs to register for VAT? Well, in the UK, there is a taxable turnover threshold, which is currently set at £90,000. That has been in place since the 1st of April 2024. Prior to that, the threshold was fixed at £85,000 and had been the case for the previous 7 years. So the increase to 90,000 was a welcome relief for a lot of people. It was always a cause of controversy, the fact that they wouldn't increase the threshold, because obviously as prices and everything are going up, more and more businesses will be being caught by this threshold and therefore having to register for VAT. Now, the £90,000 threshold, as I said, is for a 12-month period, and that is a rolling 12-month period. So, for example, if you have turnover of, say, £85,000 up to the end of October, it would be very important that you then check your turnover level for the year again at the end of November and so on, just to see if you are actually going to breach this threshold. Because if you do breach this threshold, you will need to register for VAT. Now, the threshold itself refers to taxable turnover. So there is a fairly technical definition regarding taxable turnover on HMRC's website. But in its simplest terms, essentially we're talking about any supplies that are made by a business that are deemed taxable, i.e. they are not exempt for VAT purposes. So Ashley will go into a little bit about exempt VAT a little bit later on, but typical examples of exempt supplies would be things like insurance or financial services, to name just a couple. This will also, you'll have supplies that are deemed to be outside the scope of VAT. Again, typical example of that would be if you are supplying services overseas, that would be deemed as outside the scope of VAT, so would not be included as part of your calculation. So that's kind of the mandatory threshold, which would force a business to become VAT registered. It may be that you decide to voluntarily register for VAT. So why would you want to voluntarily register for VAT? Well, one of the main reasons is that it enables you to reclaim your VAT on all the purchases that you incur. So if you're a business that has relatively small turnover, but you're incurring a lot of expenses on various things, and all of those expenses are attracting additional VAT that you're required to pay, by being VAT registered, it will enable you to reclaim that on a VAT return. So it may be worthwhile from that point of view. Other reasons you might choose to voluntarily register would be reputation. So if you operate within a fairly competitive industry and you feel that being VAT registered will sort of look good from a reputational point of view and give off the impression that you're actually an established business, you're a bigger business than perhaps you actually are, and it's more appealing to your customer base, you may decide that actually I want to be VAT registered from that reason alone. Another reason might be that by being VAT registered, it actually forces you to keep a handle on your finances on a periodic basis. So typically most businesses that are VAT registered would be required to complete quarterly VAT returns. So it does mean that you have to sort of monitor your finances at least on a quarterly basis. So it kind of forces your hand to do that rather than just completely ignore them. In terms of the VAT rates, as I said at the start, Ashley's going to talk a little bit more about the rates later on in the webinar. But typically most businesses that trade in taxable supplies would charge 20% VAT on most goods and services. There is, however, a reduced rate of 5%. Classic example of that would be home energy. Other examples of that might be, for example, children's car booster seats and other kind of safety equipment. That would be typically rated at 5%. And then you also have certain taxable supplies that are zero rated. The main example of that one being most food. So as I said at the start, it's very important to monitor your turnover as soon as you think you're going to approach that threshold of £90,000. What I'll do now is I'll just move on to the penalties that HMRC can impose. So there's really four main reasons that HMRC may elect to impose a penalty when it comes to VAT. The first one is late registration. So as we've just touched on in the previous slide, if you don't register for VAT on time, then HMRC can elect to impose a penalty. Now, the typical rules regarding registration are as soon as possible, or if you anticipate that your turnover, your taxable turnover, is likely to go above the threshold within the next 30 days, you would then be required to register for VAT. If when you look at you're calculating your annual turnover and you notice that you are going or have gone over the threshold, it would be important to register as soon as you can to avoid potential for HMRC to issue a penalty. Now, if you don't register for VAT, as I said, they can impose a penalty, and it's usually between 5 and 15%. The 15% penalty would arise if you're more than 18 months late, and that will be based on the tax that would have otherwise been due had you been registered for VAT at the appropriate time. If they do impose a penalty, it will be a minimum of £50. The second reason might impose a penalty will be because of errors. So it's not uncommon for to make an error on a VAT return. It can happen. Obviously, you try and avoid it as much as possible. But sometimes errors do arise. It's human nature. Now, if HMRC were to carry out an inquiry into your VAT affairs and discovered that an error had been made, they could, if they so wish, elect to impose a penalty, and the level of penalty will depend on the nature of the error being incurred. So if it's simply down to a lack of reasonable care, the level of penalty will typically be between 0 and 30%. If, however, HMRC deem that error to be more deliberate, it will be anything from 20 to 70%. And if there's evidence of you trying to conceal that error, it can be up to 100%. So HMRC will kind of use their own judgment based on the reasoning behind why the error has arose, and essentially impose a applicable percentage that they seem fit. The third one is late filing. So very recently, back in 2023, the penalty system regarding late filing changed. Previously, it used to be on a surcharge basis, but now the revenue have switched to a points-based system. So what that essentially means is if you submit a VAT return late, you will be given 1 point for that late return. So think of it as if you've been caught speeding or you're out driving. If you get caught speeding, typically you'll get 3 points on your license. It's a similar kind of idea. If you're late, you're not compliant, you will get a point per late return. Now, the way it works is you will get a £200 fixed penalty if the threshold is reached. So the threshold is determined based on how frequently you submit your VAT returns. So if you are, like most businesses that are VAT registered, submitting quarterly VAT returns, the threshold is 4 points. So once you get to that 4 points, you will then be issued with a £200 penalty. And if those points remain on record, for every time that you are late, you will be given another £200 penalty. Now, these points can be removed after a period of compliance. So typically, if you did get a point for late filing, but then you submitted the next 4 VAT returns on time, so i.e. for the next 12 months, if you're quarterly registered, assuming that you've gone back and ensured that all VAT returns in the previous 24 months have been filed, HMRC will remove those points. So, it's not the end of the world if you did get a point, but ideally it would be good to avoid them. As I said, it's 4 points for the threshold for quarterly. That does change. For annual VAT returns, it's 2 points, and for monthly VAT returns, it's 5 points. Now, the final one is late payment. So you can get a penalty if you are late paying your VAT. Now, again, this sort of linked with the late filing in the sense that it has been recently revamped. So if you are overdue and you're overdue within the first 15 days, HMRC typically won't impose a penalty. That being said, you will still be charged late payment interest on overdue VAT. And the late payment interest is calculated at the Bank of England base rate plus 2.5%. So currently, they're working on an interest rate of 7.5%. If you get to day 16 and you've still not paid, the revenue will impose a 2% penalty. And then if you get to day 31 and you still haven't paid it, a further 2% penalty will arise, plus a daily rate of 4% per year on the balance due, and will continue to be there until you pay it. Now, you do have options to appeal penalties. There's plenty of guidance on HMRC regarding that and what excuses will be deemed reasonable. You can also contact HMRC to arrange time to pay arrangements if you know that you're not going to be able to pay the liability in good time. So what I'm going to do now is I'm going to pass you across to Ashley, who's going to talk to you a little bit about VAT returns. Ashley.
Thanks, Andrew. So I think we hear from a lot of clients that they're not very confident around VAT. They're taking the figures as the software is producing, they're not really understanding what they mean. So this slide's mainly just to kind of go through some tips that we can ensure that you are filing with confidence. So I think one of the most important things is to know your deadlines. So typically, if you're on a quarterly VAT return basis, your returns will be due 1 month and 1 week after your accounting period ends. So typically, businesses tend to do their quarters in line with their year end. But let's say your quarter end was September, your VAT return will be due for filing and payment by the 7th of November. There is an option for companies to do monthly VAT returns, as Andrew said. Again, the deadline would still be 1 month and 1 week after your return ends. I think one thing that we can't stress enough when it comes to VAT returns is organising your records. So the easier and the more in depth you organise your records, the easier the VAT return is going to be to do. So we would always recommend tracking all of your sales and all of your purchases with a solid bookkeeping system. So these days you have to be making tax digital compliant with HMRC. So you might find that your business uses software such as Xero, Sage, QuickBooks, etc. All of those are so much easier to use when you keep track of those sales and your purchases. So making sure that you're keeping your purchase invoices, you're keeping your receipts, etc. So that when it comes to doing those returns, that information is readily available to you. And often the softwares will allow you to actually save that transaction and save a copy of that receipt or purchase invoice within the system so that everything's in one confined place. If there is any queries, then you can simply log into that transaction and pull up that information. I think also double checking your figures. A lot of clients will press submit and they'll not look at the return and not look at what they're expecting. I think it's very important to review your calculations and VAT entries before submission. As Andrew said, errors can occur. It's human nature, things will happen. But if you are checking and reviewing your information, it's less likely that these errors are going to actually occur. So for instance, if the VAT return figure is not looking exactly how you thought, you might know that you've had a particularly busy sales period and therefore you would expect the VAT to be higher, or it's thrown you into a refund position and you want to double check why that is. It might be that you've had a large purchase of, computer equipment, etc. So it's important to just check the returns to make sure that they are actually in line with what you are expecting. Finally, we'd advise, yes, we use the softwares, etc., to produce these returns, but it's making sure that it is your obligation to regularly update your software and make sure that it is up to date with HMRC and is therefore compliant. I think if there is any queries, etc., we are always here, other professionals are here so that you can run things past them, check that your software is up to date, have a look at the VAT return, make sure the treatment's correct, etc. So please do consult professionals if needed. In terms of calculating your VAT, so often you'll hear the phrases output VAT and input VAT. So effectively, your output VAT is some of the VAT that you are charging to customers. So it's the VAT that you are paying out to HMRC. In reverse, so your input VAT is any VAT that you have paid on purchases. So if you were to reclaim it, that would be VAT that you'll be getting in back from HMRC. Effectively, the figure that hits your VAT return is the difference between the two. So as the example at the bottom states, so if your output VAT, so the VAT on your sales, exceeds what you are reclaiming, this will mean that you're in a liability position and you will therefore owe the net difference to HMRC. So if the output VAT was 3,000, input of 2, you then owe the 1,000 back to HMRC. If it's the other way around, so if you get a negative result and your input VAT exceeds the output, so the simple example at the bottom, your output VAT is 2,000, you're reclaiming £2,800, you would therefore be due a refund from HMRC of £800. Now we've talked about the fact that errors do occur, and a lot of questions we get asked is, well, something's gone wrong, can I just go in and resubmit that previous return? The simple answer is no, you can't go in and adjust a previous return, but what you can do, dependent on the level of the error, is correct that going forward. So if your errors, and this is your net errors, so if you realise that there was an error on your sales and there's an error on your purchases, the net difference between the two would be your net error. If that is below £10,000, you can simply adjust that on your next VAT return. So, for instance, if you saw that you'd claimed VAT incorrectly on a purchase, you could then go into that transaction within your software, amend that firsthand, and then it would flow through as a late claim to your next VAT return. If your error is between £10,000 and £50,000, there may not be a need to notify HMRC. That depends if your error is less than 1% of your quarterly revenue. So if you fell into that £10,000 to £50,000 bracket, you would then need to look at your turnover for that period and have a look and see exactly what percentage that was. If it's below 1%, again, exactly with the previous error, you could go in and amend those transactions without notifying HMRC. If it does exceed the 1% of quarterly revenue, you need to fill in, so you need to go online and notify HMRC directly. And this is done via an online form called the VAT 652 form. And what that does is it will go through and you will pop in exactly what figures should have gone in onto the VAT return. If you've noticed that this is an error that you've done over multiple quarters, you will need to go in and amend the individual VAT returns. If you do, so if your error is between the 10 and 50 and you don't exceed the revenue, some businesses prefer to be transparent just in case HMRC did come back and investigate that. Sometimes they will write to the revenue and tell them that an error has been found, you've corrected it on your VAT return, and you are just notifying them to be transparent. To be honest, HMRC hardly ever reply, but for your peace of mind, you could do that and you could send that to them. If your error exceeds 50,000 and or the one above where it exceeds the 1% of quarterly revenue, you have no option but to notify HMRC directly via that VAT 652 form. If you do notice any errors and you want some advice on that, then please let us know and we can point you in the right direction for that form. I'm going to hand back to Andrew, who's going to go through the VAT reconciliations and making sure everything is accurate.
Help if I turn my audio on. Great stuff, Ashley. Thank you for that. So yes, VAT reconciliations. So we've kind of touched on a couple of sort of key things here in terms of the need to double check your records and ensuring that what is actually going into your VAT return does actually in fact align with what your financial records show. Now, the beauty of this day and age is that there's been a lot of advancements in automation, with making tax digital. So in a lot of cases, you can actually rely on automated processes to ensure that everything that is going into your return is accurate. But it is still very important that you are carrying out the necessary checks because even the software is not infallible and can still make mistakes. So it is definitely worth ensuring that what you expect to appear on your return is what is actually reflected within your financial records. Now, monthly reviews, this is kind of a guide because it really does depend on the nature of the business, the size of the business, but typically we would advise that carrying out a monthly review of your finances, ensuring that the reconciliations, i.e. the bank reconciliation, is done on at least a monthly basis. This will ensure that any discrepancies that you come across are caught as soon as possible. It will also ensure that if there are any issues, if you've got any missing invoices, anything like that, you can seek those out in good time rather than leaving everything to the last minute and realizing that you've not got enough time to get what you need in order to complete and file your VAT return on time. So checking invoices, kind of already touched on that. Again, ensuring that any sales and purchases are being accurately recorded into the software. Comparing bank statements. So, as I said, part of the reconciliation process, it's good practice to ensure that any payments and receipts are matching your records. Now, I should point out here that with VAT, there are multiple ways in which VAT can be calculated. It depends on what scheme you're on. So, sort of main schemes, if you like, we have the standard VAT scheme, otherwise known as the accrual scheme, which essentially means that VAT is calculated based on the date of the invoices. So, for example, if you raise an invoice to your customer, the date in which you raise that invoice will be the date that the VAT becomes due and would therefore have to be reported on the relevant return. So it wouldn't be when your customer actually pays that invoice. Now, conversely, we have the cash scheme for VAT. So if your business has annual turnover of 1.35 million or less in a year, you can potentially benefit from calculating VAT on a cash basis. And that can work really well. As I say, if you've got customers that are not paying you in a timely manner, you won't have to report that VAT until such time that it has been paid and the invoice has been paid by your customer. Now, in terms of which scheme to go on to, the best thing we can really say is if you are unsure, it would be to contact us so that we can have a look at it for you. It's not always a clear-cut decision, and there are some special schemes as well, such as the flat rate scheme. There are a few others as well, second-hand margin scheme, tour operators margin scheme, whatever it may be. There's various ways to be able to calculate VAT, and for all businesses, it's all individual. So not one scheme fits all. It really does depend on how things are going with your business, what you're trading in, and how frequently your customers are paying you, whether or not you have any credit suppliers. So there's a lot of things to consider, but we can certainly help with that to ensure that your VAT is being calculated correctly. Now, documenting adjustments. So as Ashley has already touched upon, in terms of reporting errors, there are various ways of doing that. What I would say is if you are going to correct an error within a subsequent VAT return, that you have that well documented, so you have the invoice there. And say it can happen. It's easy to happen. It might be that you just didn't get an invoice in time, or there was an issue raising an invoice to a customer, whatever it may be. As long as any sort of late corrections are being made and reported correctly, there will be no problem. So just moving on then, so to group returns. Now, group returns is an interesting area and is one that can be very beneficial for somebody that has multiple businesses, or you own a business that is part of a group, i.e. it's either being controlled or controls another business. Now, the idea of this is that instead of all of the entities within the group having to submit their own VAT return, it enables one single VAT return to be filed for that whole group, which is really great because it reduces the administrative burden. So, for example, you can imagine if you've got a group of, say, 10 different companies, the idea of having to file 10 different VAT returns can be quite annoying, and it might be easy to miss one out. So by only having to file one, that will really help and makes life a lot easier from that point of view. Now, in terms of who's eligible for group VAT treatment, it really boils down to whether or not there is a centralised control in place. So that can stem from one of the members of the group. So, for example, Company A might outrightly own Company B, and as a result, Company A and Company B are in a group, very simple group, and therefore can apply for group VAT treatment. It may also be that somebody outside of the group actually controls all the entities within that group. So if you're an individual and you are the director of multiple businesses and you have all the voting rights and you're deemed to have all the control within each of the entities, again, there is scope there to apply for a group VAT treatment. For anyone that's actually ever tried to register for VAT online with HMRC, you will know that it can be quite burdensome. Some of the questions are a little bit annoying, particularly when they start asking things about other involvements and what have you. And the reason they're doing that is because they're basically trying to determine whether or not there's been what we call a disaggregation of supplies. So, for example, if you have a business in, say, plastering and you're turning over £50,000, but then you also have a flooring business and that is also turning over £50,000 in a year, you may decide that actually they're two separate businesses. I therefore don't need to register for VAT. But HMRC, on the other hand, may turn around and say, no, I think what you're doing is simply disaggregating your business to avoid being VAT registered. We therefore think that there's not a clear and distinct difference between the two, and we therefore require you to register for VAT. So it can work sort of both ways with group VAT. The main benefit of it is that if there is any what we call inter-entity transactions or intra-group transactions, there is no VAT on those and they can be ignored when completing the group VAT return. So obviously if you had two entities, one was trading with the other, if the entity was trading in taxable supplies, normally taxable at standard rate, if they are not in a group, if they're not in a VAT group, that entity would have to charge 20% VAT on its invoice. However, if the two were in the VAT group together, they would not need to because it would be deemed as intragroup and therefore be ignored. So that's a big positive on that side of things. It is important that even though you do only need to do one return, that the record keeping is still up to scratch and that you're maintaining detailed records for each entity, and also ensuring that you are actually reconciling the records for each entity to ensure compliance. So, you still need to sort of do those reconciliations, ensure you're carrying out those checks to remain accurate. Now, group VAT is quite a technical area. There is some very detailed guidance on HMRC about it and about the various scenarios. There is some anti-avoidance, what we call anti-avoidance provision in place whereby HMRC have the power to refuse an application for group VAT. I won't go into the detail of that too much, but essentially it's all to do with the protection of the revenue if they feel that actually it's going to lose them money, essentially. That is why they could refuse a group application. So I'm going to pass you back to Ashley now, who's going to talk to you a little bit about the bookkeeping side of things before going into some pitfalls. Ashley.
Thanks, Andrew. So the end point is your VAT return, but obviously those transactions come from the bookkeeping and the transactions that have been put onto your system. We have a lot of clients that say that bookkeeping is very tedious, it's very time consuming, there's lots of manual entry, etc. And then often things are left till the last minute, things are rushed, and therefore, it pushes it to that deadline, and that's when mistakes can be made. In terms of streamlining the tasks, there are various things that you can do. So, for instance, cloud accounting. So that will automate the VAT transactions for you and integrates directly with HMRC. So it can ensure that the software will know the transactions, know the applicable rates, and can therefore then flow that through directly. There are various softwares that we advise to clients for them to use that will enable them to automate their tasks. So by using automation, you can scan your invoices using an external software, and that will automatically then flow through to your bookkeeping software. So for instance, one of the most common ones is Dext that we get clients to use, which effectively you can scan in, take photographs, etc. of your purchase invoices and your receipts, and that will scan automatically into the software. It will pick up the customer or the supplier. It will pick up the applicable transaction accounting code based on ones that have been done historically, the date, the invoice number. It will also differentiate between the net figure and the gross figure, so it should pull out that VAT for you. Now, we do need to ensure that we are still checking those transactions, because even though the VAT rate and the VAT amount might be correct, we need to ensure that the rate is correct also. So it is important that even if we are using these softwares, we are still making sure that things have been coded correctly. In terms of categorizing transactions, so quite often clients can get very confused between their certain VAT rates that are all extremely similar. So for instance, you've got zero rated VAT, exempt VAT, and outside the scope, which is no VAT, and they all look pretty much identical. Now, there is a difference between the three, and I am going to run through those for you. So zero rated for VAT purposes effectively means that the customer does not have to pay VAT. However, the supplier can still reclaim the VAT on any amounts that have gone into making that end purchase. So in HMRC's eyes, it is a taxable transaction, but it is taxable at 0%. But it effectively means that it is not taxed at the point of sale. So for instance, new builds are zero rated. So if you and I were to go out tomorrow and buy a house, there wouldn't be VAT on that. Now, the builders that have put together that house will have been able to reclaim the VAT on some of those materials, etc., that have gone into making that end product. So although there's no VAT at the end point, it does allow you to reclaim the VAT, obviously in building that house and putting that together. There are some other examples. So I think we mentioned right at the beginning, but food and drink is an example of zero rated VAT. This does exclude alcohol, confectionery, crisps, etc. Another one is books. So the actual book won't have VAT on it when it's sold. However, the purchasing of paper, the purchasing of ink, etc., potentially the printer's costs will have VAT on them. Another example is children's clothing. So adults' clothing does actually have VAT on it, children's, however, does not. The other type of VAT is exempt VAT. So this is where under no circumstances will VAT be charged or can VAT be reclaimed. So one of the prime examples is insurance and financial services, any charitable fundraising events, healthcare, so medicines, doctors, dentists, etc., all will never charge VAT and they will always be exempt. Now, we quite often see clients who get an invoice from a supplier. That supplier may not be VAT registered, and therefore they automatically pop that as no VAT. When you do put a transaction as no VAT, so outside the scope, what that means is it doesn't hit your VAT return at all. So when you're doing your transactions, obviously the VAT amount on sales goes to your box 1. The other side of it, so the net figure, will go to your box 6. Likewise with your purchases, it will hit your box 4. The other side will go to box 7. If you put them as no VAT, they don't hit that VAT return at all. So it's very important that even if a supplier doesn't have VAT on their invoices because they're not registered, we need to consider that transaction and how that would be treated. So most of the time, we would therefore pop that as zero rated, because that would then ensure that it's still flowing through to your box 7 on your VAT return. If HMRC were to investigate for whatever reason your VAT returns, they would look at the box 7 figure and look at what they would be expecting the VAT to be. So we need to ensure that transactions are flowing through to there correctly. HMRC do have some guidance on the different VAT rates that are applicable on their website, and it's actually called HMRC VAT rates for different goods/services. And on there, they do break down any building costs, any education, medical, etc., and what that usual treatment is. But it is a complex area, knowing what the different transactions should be. So if ever you're unsure, please do drop us a message. If you come across something unusual and you're not sure how it should be treated, then please let us know and we can assist where possible. There are sometimes some pitfalls that we regularly come across with the VAT returns when we're looking at the bookkeeping and we're assessing, you know, we're reviewing that return to see what's gone on. These are the most common ones. There might be some others that you can think of, but in terms of the common ones, so client entertainment is a big one. So VAT should never, never, never be reclaimed on client entertainment. Client entertainment is not allowable for tax purposes, and therefore the VAT on these transactions is also not reclaimable. Quite often you'll see you've taken clients out to dinner, restaurants will charge the VAT, but we cannot reclaim that. So it's just obviously if you were to put that receipt into an automated software, dependent on what code you pop it as, would mean that the system may get that VAT rate incorrect. So if you were putting this to subsistence, for instance, the VAT software might not know that that's obviously actually entertainment, and the VAT therefore may be reclaimed on that. So some softwares, such as Xero, if you do post anything to the entertainment code, it should automatically default to 0% VAT. But again, we just need to ensure that we are checking that afterwards. Another common one is insurance tax. So a lot of the business insurances, professional insurance, you'll see the rate for the premium for that year, and then you'll also see a line underneath it that states insurance tax. This is completely separate to VAT. Quite often clients can get a little bit confused and they will put that as VAT to be reclaimed. As we said earlier, insurance is always exempt, so there will never, never, ever be VAT on that one. Private expenditure. So these transactions should be coded to your director's loan accounts, and any private expenditure, if the expense isn't allowable, neither is the VAT. So we just need to ensure that any private transactions do go as no VAT. They are completely outside the scope and we don't want them to hit our VAT return. In terms of the no VAT, sometimes there's also transactions such as, your net wages, your pension costs, etc., that will be coded to that. Now, we spoke about food and drink, and that predominantly, yes, they are zero rated. This is with the exemption of hot food. So I mentioned above that restaurants will charge VAT. Takeaway hot food actually is 20% standard rated. Cold food takeaways are not, but hot food is. So if you've got, you've gone to Costa, you've got a takeaway coffee, you will see on there that there should be 20% VAT, and that is fully reclaimable. One of the other pitfall areas that we see that is quite common these days, particularly because a lot of businesses are now leasing the likes of electric cars, and that clients sometimes don't know about it, there is a VAT restriction on leased cars. So often the suppliers will send an invoice and you will see a restricted VAT amount on there. But effectively what it means is they will charge their VAT at 20%, but to cover the provision for any private use of that lease vehicle, that VAT is restricted to 50% of the total VAT amount. So often it is split out on your invoices, but it's just worth keeping an eye on that because we do need to ensure that that VAT is being restricted.
Great stuff, Ashley. Thanks for going through all of that. So just to recap what we've spoken about today, we've touched on a few different areas. So to start with, we talked about the threshold and who actually needs to register for VAT, and the idea that some businesses might actually voluntarily choose to register for VAT. Before talking a little bit about various penalties that HMRC can impose and the different rates around those. Ashley then talked to you a little bit about the VAT return, how it's actually calculated, and the mechanism for reporting errors depending on how big or small that error is. I then talked to you a little bit about VAT reconciliation. So what you need to really be doing to ensure that you're getting your VAT return correct, the checks you should be undertaking on a periodic basis, it's a lot of that might seem like common sense, but it's so important that you are doing those checks to try and reduce the level of errors that are going into the returns. We then touched a little bit on group returns and group VAT treatment, who can actually benefit from it, and the benefits of being in a group, in a VAT group, and also the need to actually ensure that every entity is still maintaining you know, strong reconciled records, even though only one return is actually required for the whole group. Ashley then talked to you a little bit about bookkeeping, touched on making tax digital. Again, the need to ensure that you're categorizing transactions correctly, the different rates that are there, before finally going over some of the common pitfalls that tend to trip a lot of people up when they're completing their VAT returns. So we've kind of scratched the surface a little bit with VAT during this webinar. It's a very complex tax, arguably the most complex tax around. There are a number of different areas to VAT, and to a lot of people, it can be quite overwhelming, or trying to understand what they need to do can be quite daunting. So just to reassure you guys that we are here, and we are here to help and advise. So if you're a new business and you're not sure whether VAT registration is right for you or whether you need to, you can contact us and we can help you along the way, get you set up. Equally, if you're an existing business and you're not sure what you're doing is actually correct, whether you're doing it in the most tax efficient way, again, feel free to contact us and we can help you along the way with that as well. Now, I know that Shelley has been keeping a close eye on questions that have been coming in, so has been doing a marvellous job. So thank you very much, Shelley, for doing that. What have we got? What have you got for us?
Excellent. So thank you so much, guys, for taking everybody through that. It's much appreciated. I've had quite a few questions in, so we're not going to be able to get to all of them because I'm very aware I don't want to sort of tick too far over the 45 minutes hour mark. But we will get back in touch with people directly to help answer those questions. I've filtered out a couple. So this is one we see quite often for clients. So my VAT figure on zero does not look how I expect it to. Can I use the VAT adjustment option to amend it to what I believe it should be? I don't know who of you wants to take that on.
I'll take that one if you like, Andrew. In terms of the manual adjustment button on the VAT return, we would never recommend to just go in and do it that way. It can get quite messy. Sometimes the audit trail is quite complicated and it's quite hard to follow through. So I think if you have spotted something on your VAT return, it doesn't look quite right. This is where it then comes back to the importance of reviewing that and actually looking at the detailed breakdown and seeing, is it that your sales, you've popped a credit in, for instance, and that's making your top box negative, and kind of unpicking it that way, because I think it's easier to go into the individual transactions to amend those, because then there's an audit trail in the software and we can flow that through correctly.
That's great. Thank you, Ashley. And then another one. So does Knights Lowe offer VAT reviews to non-clients? Andrew?
Yeah, yeah. So we absolutely do. We can provide a service. We can provide whatever you need really in terms of VAT. So if you wish us to sort of do the whole bookkeeping process, complete the VAT return from scratch, we can do that. Equally, if you're comfortable maintaining your own bookkeeping and ensuring everything is up to date, and you simply just want us to take a review of your return just to make sure there's nothing standing out, no errors that have gone in. Again, we're more than happy to do that. We don't just sort of say this is the only service that we can provide. We can be adaptable in that sense. So we can do as much or as little as you feel you need us to do. Even if you started off by, asking us to do a review, and then you actually decided, what, I want to, I'd rather take a step back, I'd rather let you guys handle all my bookkeeping affairs. We can certainly do that, and vice versa as well. If you want us to start off doing the bookkeeping for you, and then you actually decide, no, do you know what, I want to do this myself. I feel I'm comfortable doing this and getting a handle on this. Then again, we're more than happy to do that. So we can absolutely offer a VAT review only service if that is what you wish.
That's great. Thank you, Andrew. I think on there as well, it's been quite interesting lately. We've had a lot of clients come to us recently and say, can you take over the VAT and the bookkeeping? Because actually clients have realised they're wasting 2-3 days sort of fumbling through their bookkeeping each month and not being overly confident, whereas actually they've realised if they pay a professional to do it, they can actually generate more revenue from those 2 or 3 days doing what they're good at, what their skill base is. And we're seeing a big shift in that trend. I think people are looking at the time available to them and saying, actually, if I can bill 2-3 days to my clients, it's better off that I pay Knights Lowe or my other accountant or bookkeeper to do that bookkeeping and VAT. And it takes some of the risk away from that individuals as well. So yeah, it's been an interesting shift we've seen lately. Another one, which is a good question. So how do I know if I've already got penalty points from HMRC for my VAT?
Okay, yeah, no, that's a great question. Thank you very much for that. So when it comes to penalty points, there are a couple of different ways you can find out. The first one is that when you do actually get issued with a point, HMRC will typically send a letter notifying you of the point and how many points you actually have. So that's the first one. The other way is you can actually go onto your VAT account and you'll be able to see for yourself how many points you've got. As I say, as I touched on earlier, it's fairly generous in the sense that you can actually miss filing your VAT return on 3 occasions if you're on a quarterly basis and still not get a penalty, as long as you are paying it. So that's not a bad. It's not a bad actually regime from that point of view, and those points can easily be removed. As I said earlier, which is great. So yeah, it's hopefully that answers your question. Normally it's quite straightforward to sort of find exactly what position you're in. All right.
Perfect. And I'll just do one more. So this one's come up a couple of times. So I'm currently VAT registered, but my turnover has fallen. What's the deregistration limit and what do I need to do to deregister?
Yeah, it's a really good point, actually, and one that I probably should have covered in my webinar. So thank you for bringing that up. The VAT deregistration threshold, there is actually one there. It's currently set at £88,000. Previously, it was £83,000. What that essentially means is if your turnover goes below £88,000, you can deregister for VAT on the grounds that your turnover is below the threshold. It's not a case of once you get to the £88,000, you're automatically going to be deregistered. It's not how it works. Because as I said, you can be registered regardless of what your turnover level is. But there is a threshold. So if you did want to deregister and the reason was simply because my income isn't enough, as long as it's below that £88,000, that's absolutely fine.
That's great. Thank you both so much. And thank you for taking us through that content. I hope you found this useful. On screen are all of our contact details. If you do have any questions at all, please do reach out. We're more than happy to help. If you're an existing client, you might want to reach out to one of us or your original contact. If you're someone who's not previously worked with us at all, pop a contact email to either of us and we'll get back to you and hopefully be able to help you with that. But yeah, hopefully you found this helpful. And like I said, it's going to be on our website in the next couple of days, so you'll have it there to watch back. So thank you very much for attending, and thank you, Andrew and Ashley.
Thanks very much, Shelley. Thanks, guys.
Shelley. Thank you.
You.